Friday, September 12th, 2008, 6 a.m., Dick Fuld wakes up and his bank is still alive. By Sunday night, it will be gone. 158 years of history, $639 billion in assets, 25,000 employees, erased in a single weekend. Not by a war, not by a recession, not by an act of God, by a phone call that never came. This is the story of 48 hours that changed the global economy forever, told in real time. Because the only way to understand what happened inside those rooms, inside those calls, those boardrooms, those hallways, is to feel the clock ticking the way the people inside felt it. You already know how it ends, but knowing the ending doesn't prepare you for how it got there. To understand the weekend, you need to understand the man. Richard Severin Fuld Jr. had run Lehman Brothers since 1994, 14 years. On Wall Street, that's a dynasty. He was known as the gorilla, not as a compliment exactly, but not as an insult either. It was respect, the kind of respect that comes from watching someone dominate a room for decades. Fuld was Lehman, and Lehman, under Fuld, had become one of the most aggressive investment banks in the world. Through the early 2000s, Lehman went deeper into the mortgage market than almost anyone. They weren't just selling CDOs, they were buying mortgage lenders outright. They owned the factories that made the product they were packaging. By 2007, Lehman had $85 billion in mortgage-related assets on its books, and they were leveraged 30 to 1. 30 to 1 means for every single dollar of Lehman's own equity, they owed $30 in debt. It means a 3% drop in asset values, 3%, wipes out all of your equity entirely. In 2008, mortgage assets weren't dropping 3%. By early September 2008, Lehman's stock had lost 77% of its value since January. Counterparties, the banks and institutions that did business with Lehman every day, were growing nervous, quietly pulling back, reducing their exposure. Fuld had been trying to raise capital for months. He'd approached the Korean Development Bank. Talks collapsed. He'd explored other options. Nothing materialized. By the second week of September, the window was closing fast. On Thursday, September 11th, Lehman announces a third quarter loss of $3.9 billion. The stock drops another 42% in a single session. Friday morning arrives, and Dick Fuld is making calls. Friday, September 12th, morning. The Federal Reserve Bank of New York is a fortress of a building in lower Manhattan. Thick stone walls, vaulted ceilings, the kind of architecture that is designed to communicate permanence. Timothy Geithner, the president of the New York Fed, calls an emergency meeting. He summons the CEOs of every major Wall Street bank to a meeting that evening. Not a conference call, a meeting, in person, at the Fed. The message is clear. This is serious. By Friday evening, they are all in the room. Jamie Dimon from JP Morgan, John Tain from Merrill Lynch, Lloyd Blankfein from Goldman Sachs, the heads of Morgan Stanley, Citigroup, Deutsche Bank, Credit Suisse, the most powerful bankers on earth sitting around a table on a Friday night staring at a problem none of them fully wanted to own. Geithner lays it out plainly. Lehman is failing. There are two potential buyers, Bank of America and Barclays, the British bank. One of them needs to make a deal by Sunday night, because Monday morning the markets open, and if Lehman opens Monday without a deal, the consequences will be uncontrollable. He doesn't say exactly what uncontrollable means. He doesn't need to. Everyone in that room knows. Meanwhile, Dick Fuld is not in the room. He is waiting, making calls, trying to reach anyone who might help. He has been effectively removed from the negotiations at this point. The Fed and Treasury are running the process now. The man who built Lehman into a global institution is watching from the outside while other people decide its fate. That detail by itself tells you something about how far things had fallen. Friday night into Saturday, the two tracks are running simultaneously. Bank of America is interested. Their CEO, Ken Lewis, has been in conversations with Lehman for days. A deal would make Bank of America into a superpower, combining their retail banking with Lehman's investment banking capabilities. The numbers are being worked on through the night. At the same time, Barclays is in the room. The British bank is also circling. They see opportunity in the wreckage. Lehman's North American investment banking business, the people, the clients, the infrastructure, could transform Barclays overnight. But both potential buyers have the same problem. Lehman's books are full of assets that nobody can properly value. Mortgage-backed securities, real estate positions, complex derivatives. The due diligence process that would normally take months is being compressed into hours. And the number that keeps coming up, the hole in Lehman's balance sheet, keeps growing the more people look at it. Estimates range from $65 billion to $85 billion in troubled assets that no buyer wants to absorb. Both Bank of America and Barclays are asking the same question. Will the government guarantee some of the losses? Will the Fed backstop the bad assets the way it had for Bear Stearns 6 months earlier? Hank Paulson, the Treasury Secretary, had flown up from Washington. He was in the building, and his answer, delivered repeatedly throughout Friday night and into Saturday, was unambiguous. No government money, no backstop, no Bear Stearns deal for Lehman. This was a line Paulson had drawn publicly. The political pressure was intense. Bear Stearns had caused outrage. Taxpayer money used to save a Wall Street bank. Paulson could not go back to Washington with another bailout, or so he believed on Saturday morning. The clock is ticking. Saturday turns to Saturday night. Saturday night, the Bank of America track collapses first. Ken Lewis has been running numbers all day. His advisors are telling him the same thing. The hole is too big. The liability is too uncertain. Without government protection on the bad assets, Bank of America cannot absorb the risk. And then something else happens. Merrill Lynch calls. Merrill Lynch, another investment bank, also drowning in mortgage exposure, also facing existential questions about its own survival, reaches out to Bank of America directly, separately from the Lehman talks. The offer is simpler. Merrill's assets are more transparent. The price is negotiable, and acquiring Merrill would achieve most of what Lewis wanted strategically without the terrifying unknown of Lehman's balance sheet. By Saturday night, Bank of America is no longer looking at Lehman. They are buying Merrill Lynch. The news hits the room like a stone. One of the two lifelines gone. Overnight. That leaves Barclays. Sunday morning, one option remains. Barclays is still in the building. Their CEO, Bob Diamond, is working the phones. Barclays wants this deal. They want Lehman's U.S. operations badly enough that they have been willing to stay in the room through the entire weekend. But there is a problem, a very specific, very technical, very fatal problem. Under British financial law, Barclays cannot guarantee Lehman's trading obligations without a shareholder vote. A shareholder vote cannot be called and completed in hours. It takes weeks. The British financial regulator, the FSA, will not waive this requirement. Geithner calls the FSA directly. The answer is no. Barclays cannot legally close a deal by Sunday night. The room goes quiet. It's Sunday afternoon. Both options are gone. The Federal Reserve and Treasury are staring at a Sunday night bankruptcy, the largest in American history, and there is no third option waiting in the wings. Some accounts suggest a last-ditch attempt. Could the Wall Street banks themselves pull money to fund a rescue, the way they'd done with long-term capital management in 1998? The numbers are run. The gaps are too large. The will isn't there. Each bank CEO is looking at their own exposure, their own weekend of crisis, and doing their own math. Nobody moves. At approximately 1 a.m. Monday morning, September 15th, 2008, Lehman Brothers Holdings Inc. files for Chapter 11 bankruptcy protection, 158 years. Monday morning, 6 a.m., 25,000 Lehman employees wake up and check their phones. Most of them find out from the news. There is no internal memo waiting in their inbox, no company-wide call, no message from Dick Fuld. They turn on CNBC or open their phones and read the same headline everyone else is reading. The same headline that is already moving markets in Tokyo, London, Frankfurt. Lehman Brothers has filed for bankruptcy. And then, and this is the part that still generates a particular kind of rage, they begin to understand what that means for them personally. Their jobs are gone. Many will find out whether they still have jobs only when they try to badge into the building and the card doesn't work. Their stock, much of Lehman's compensation was paid in company stock and is worthless. Their pension plans, tied up in company accounts now frozen in bankruptcy proceedings, are inaccessible. They had worked for this institution, some of them for decades. They had been told, the way you are always told at these places, that the firm's success was their success, that the stock meant something, that loyalty paid. While Dick Fuld in the years between 2000 and 2008 had paid himself approximately $500 million in total compensation. $500 million from a company that was borrowing $30 for every dollar it actually owned, from a company that would require taxpayers to help clean up the wreckage it left behind. Monday is carnage. The Dow Jones drops 504 points. Lehman's collapse freezes credit markets globally. Reserve primary fund, a money market fund so conservative it was considered almost the equivalent of cash, breaks the dollar. It had been holding Lehman commercial paper. Suddenly it was worth less than $1 per share. Money market funds were supposed to be safer than savings accounts. The panic spreads in hours. Companies can't access the short-term credit markets they use to make payroll. Banks stop lending to each other. The entire system begins to seize. Within days, Washington Mutual will fail. Within weeks, Congress will pass $700 billion in emergency bailout funds. The dominoes that Dick Fuld had spent a decade stacking, they are all falling now. Here's the accounting. Dick Fuld, $500 million in personal compensation, 0 criminal charges. He later claimed in congressional testimony that he had no idea the risk was as severe as it was. He was questioned by Congress in October 2008. Members of the committee asked him directly how he felt about what had happened to his employees. He expressed regret. Then he went home. The Lehman executives who structured the accounting tricks, a scheme called Repo 105 that temporarily moved $50 billion off the balance sheet to make the company look healthier than it was before each quarterly report, were investigated. No criminal charges were filed. The Department of Justice looked at the evidence. They looked at the emails. They looked at the accounting. They made a decision. Nobody went to jail. The employees who lost their pensions, a bankruptcy settlement eventually recovered a fraction. Some got nothing. The taxpayers who funded the broader bailout, TARP, eventually returned its money, broadly speaking, with modest interest. The systemic damage, the jobs lost, the homes foreclosed, the retirements gutted, that was never recovered in any ledger. And the lesson that Wall Street took from all of it? That is a question you have to answer for yourself. 158 years. A company that had survived the Civil War, 2 world wars, the Great Depression, the dot-com crash. Gone in 48 hours. Not because markets are random, not because risk is unforeseeable, because the people running the institution had chosen for years to borrow more than any rational risk model would support, to pay themselves with money the company didn't really have, and to present a balance sheet to the world that didn't reflect reality. The 48 hours were just the moment the math caught up. It always does. The only question in 1929, in 2008, in every crisis that came before and every one that will come after is who pays when it does. It's never the people who built it. The executives who walked away from Lehman with their bonuses intact weren't an exception. The story of who gets protected when financial systems collapse and who doesn't runs through every major crisis in modern history. The next video follows that thread directly. You'll want to see where it leads.